Well, good afternoon, everyone, and welcome. Today's presentation is how to get the most out of your Social Security benefits. We are so excited that you've joined us today. This is a very fast-paced presentation, lots of information. Please grab a pen and paper, take lots of notes. The good news is we record all of these presentations. We will be sending the replay of this same presentation to you, including slides, sometime by the end of next week. But again, please take good notes and let us know how we can help. If you do have questions, at the bottom of the screen, you're going to see a Q&A icon. Please type in your questions as they come up, and that way we can address all of the questions at the end of our presentation. And we found that those are very helpful because if you're thinking that, others are probably thinking the same thing. Our important disclosure information, something you've seen many times. And of course, without saying, these are the esteemed wealth advisors, myself, Sam, and Adam. All of us are here to help you. We work collaboratively as a team, so either one of us can help with any of your questions and planning needs. At this point, I'd like to turn the meeting over to Sam. He's going to take us through the presentation, and then I will join back at the end to kind of wrap things up and do Q&A. Sam?
Thank you for that introduction. And as Jordan said, we have a lot to go over today. But before we start learning about the ins and outs of Social Security, the first item we're going to be discussing is it even going to be there for you? We want to make sure that you're using your time wisely today. And so we're starting with that topic in terms of where does the trust fund sit? Is it going to be around for the long term? Can we rely on it? We're going to be touching on all those topics. Then we'll be getting into Social Security 101, the basics. Then when should you apply for Social Security, the best strategies to maximize benefits, and is Social Security enough to live on in retirement? So let's just jump right in. And this particular topic of if Social Security is going to be there for me, we could dedicate to an entire presentation. We could do it in an hour just on this one particular area. So we're going to be discussing where things are at, strategies on how to fix the current situation. But if you have any questions, of course, please ask them or reach out to us separately so we can dive deeper into all that. So Social Security is designed as a pay-as-you-go system. Payroll taxes from current workers go into a trust fund and are immediately paid out to current retirees. Because baby boomers have been in their peak earning years, the trust fund has accumulated more than the current benefits. However, right now, the trust fund holds about $2.8 trillion that's invested in treasuries. But as baby boomers start retiring, these trust funds are gradually going to be drawn down. As we can see, the trust fund balance at the end of 2022 was $2.8 trillion. 2.83, and at the end of 2023 it was 2.78 trillion, and we could see exactly the income and the expenditures to which there was a decrease in the assets in 2023 of $41 billion. So what does this ultimately look like as we project it out over the next couple of years? Now there's a lot to see here on this slide, but the main area where I want to begin is in this yellow box. And what this yellow box tells us is that regularly scheduled benefits will continue through 2033. However, beginning in 2034, if no changes are made, the Social Security trustees expect that there will be a 20% haircut. That means everyone who is receiving benefits will get 20% less, and all future Americans will receive 20% less than what is being expected. And if nothing has changed after that point, the expectation is that the next cut will occur in 2097, upon which time it will be reduced another 6% to 74% of benefits. So what we're looking at here on the chart above is the thick blue line shows the cost of the program. And we could see at some point, and this happened a number of years ago, the costs started to outweigh the interest that was ultimately earned, upon which in 2034, the system is going to have to reset and have that big cut if no changes are ultimately made. The dotted line that we're seeing above, this is what the cost would continue to grow to if no changes were ultimately, made from the program. So how can we fix things? Because it seems inevitable that changes do have to be made. So these are different ideas that are being proposed right now, but do I think that one of these strategies is more likely than the others? It's really difficult to say. This is an election year, and generally speaking, reforming Social Security seems to be an untouchable for both parties. So do we expect this to be solved in 2024? Probably not. We think that this will be something that will probably occur in future years, and hopefully it won't come down to the last minute. Let's go through some of these different strategies. The first one is increasing the maximum earnings that are subject to Social Security tax. In 2024, the maximum amount of your income that's eligible for Social Security tax is $168,600. So what this means is that if you make over that amount, you are not taxed and paying into Social Security for those dollars. So if they increase this number to a higher level, that would, in theory, also start generating more money to go into Social Security. The con of this program is that if you're taxing more, the way Social Security is set up is those folks would also be collecting more down the line. But this is certainly one idea. The next one is to raise the full retirement age. And we're going to be talking a lot today about what full retirement age means. But currently, the full retirement age is 67 for those born in 1960 or later. It used to be 65 and has gradually worked its way up to 67, but it has not kept pace with the Americans' life expectancies. So increasing that and continuing to move up to be more in line with how long folks are living is another strategy that's being discussed. The third one is lowering benefits for future retirees. This, I would say, is the most unpopular of all the items that are, brought here on the on the presentation today, but certainly nothing is off the table considering where we're at. The fourth is reduce cost of living adjustments. So Social Security was designed to not only provide income in retirement, but also to provide inflation protected income in retirement. So every year, Social Security assesses whether or not inflation was higher in the last year than the year before. And if that was the case, they do increase your benefit by the cost of living adjustment. So in the future, they could have those increases be smaller than what we've experienced in the past, or make sure that they're lesser than inflation, if you will. The fifth option, is reduce delayed retirement credits. So for every year that you wait beyond your full retirement age, Social Security increases your benefit by 8%. And so reducing these delayed retirement credit means instead of getting that 8% increase for every year beyond your full retirement age, perhaps it's 6% or 5% or some lesser number. So again, we don't have an inkling as to which one of these ideas is ultimately going to win out, when that is going to happen, or if it's going to be some combination of all of these, or even other ideas that are being proposed that are not included here. But the bottom line for baby boomers is that your benefit is likely not to be reduced by Social Security reform. There are roughly 68 million Americans that are receiving Social Security, and the vast majority of them vote. And we have a sneaking suspicion that they're likely not going to vote for anyone who's going to reduce their benefit. The last time Congress made changes to Social Security was in 1983, and the trust fund was just within a few months of running out. So theoretically, they have until 2034 to get their act together and rewrite the system, but we hope certainly that reforms are made sooner than later. But in all likelihood of what that looks like, again, we feel strongly that for those receiving benefits, They're likely not going to receive too much of a reduction, if anything at all. We think it's going to be younger Americans that are ultimately going to have to get the system back on track. So now let's switch gears and talk about the basics, Social Security 101. So there's important things to know about Social Security before we dive in. One is that you have many claiming options. It is not as simple as doors 1, 2, or 3. If you are a married couple, there are 81 different ways that you can file for benefits. And the decisions that you make, each spouse, have far-reaching consequences. And so it's very, very important to make sure that you know exactly what you're doing before you do it, because a lot of these choices as well can be irrevocable. Fourth is the system is not bankrupt. I did just explain that the trust fund is likely going to run out at some point in 2033 or early 2034, but the system is not bankrupt, and I can go into more detail on that with you if you'd like. And the last one is your friends and coworkers are not experts. Jordan and Adam and I cannot tell you how often questions are brought to us about Social Security, and they always start with, I heard from X, I heard from my neighbor, I heard from my cousin, I heard from this person, and they told me this about Social Security. And more often than not, that information, quite frankly, is not entirely accurate. This is too important to take advice from folks who are not dealing with this on a daily basis, that don't have the experience of helping folks with Social Security timing over many, many years. So please keep that in mind. Now let's jump right in. So who is eligible for Social Security? There's 3 types of folks. Most Americans receive Social Security by working long enough to qualify based on their retired benefits at 62 or later. However, if you are the spouse of a retired worker, you may also qualify for spousal benefits now or in the future. If you're divorced, you may also qualify for benefits if the marriage lasted at least 10 years and certain other conditions are met. If you are the widow or widower of a retired worker, you're probably eligible for Social Security survivor benefits. There are several other categories of eligibility which involve minor children or the disabled, but we won't go into those matters today. If you think they apply to you, please contact me and we can review your specific situation. So how is the benefit calculated? Well, to qualify for Social Security, you must have worked for at least 40 quarters, which is approximately 10 years. And to qualify for work, you must have earned reported income and paid your Social Security taxes on it. The size of your benefit in retirement depends on how much you earn during your working life. And the Social Security Administration keeps a record of how much you made every year up to that ceiling, which for 2024 is $168,600. Any amount you made over that ceiling does not get taxed, and it does not figure into the formula. When it's time to apply for your benefits, Social Security will look at the highest 35 years and substitute zeros if you didn't work a full 35. They'll then apply a formula to arrive at your basic benefit, which is the sum that you'll be able to collect at your full retirement age. We're not going to get into details about that formula specifically, but if you are curious, you can go to ssa.gov to learn more. Another important point is that Social Security is inflation protected income. We talked about this a little bit earlier, but Social Security has COLAs every single year, which are not guaranteed. They are supposed to keep pace with inflation, but ultimately the inflation that seniors receive via the way they spend their money is often much greater than what you see from the COLAs. So it does help with some part of the increase in your costs, but I wouldn't expect it to fully keep up. So now let's talk a little bit about taxation. Ever since 1984, Social Security has been subject to some level of taxation. And yes, you did hear that correctly. You were taxed, and that's how you paid into Social Security. And when you begin to receive benefits, you will also be taxed on those benefits as well. So this table here shows you the various income levels. Now, when we refer to income, specifically as it relates to the taxation of Social Security, we're referring to provisional income. Provisional income is your adjusted gross income, or AGI, plus 1/2 of your Social Security benefit, plus tax-exempt interest. Tax-exempt interest is municipal bond interest. And you can see for married filing jointly, there are two levels to be aware of, 32,000 and 44,000. And you can see where you fall within those on the right-hand side, whether or not you're going to have your Social Security be taxed. If you are married filing separately or living with the spouse, then you're automatically 85% of your Social Security benefit is going to end up being subject to taxation. Whether or not Social Security ends up being taxed in the future is also another proposal that is being floated in Congress right now. Its likelihood of passing is uncertain, but it's another suggestion that is being thrown out there. So when should we apply for Social Security? There's three important ages to be mindful of, and we'll begin with the first one, which is 62. That is the earliest age that you can receive benefits unless you are disabled or a widow or widower. And we'll talk about widow and widower in just a little while. If you file at age 62, your benefit is going to be reduced by 25 to 30%, depending on when your full retirement age is. And that reduction is going to be permanent. So if you decide to file early and continue receiving those benefits, do not expect that you will make that up over time. The next area is the full retirement age. This is where you receive 100% of your benefit. Now, it is sometime between 66 and 67, depending on the year in which you were born. Lastly, after full retirement age, your benefit increases 8% per year for every year that you wait. And this is a permanent increase, and it maxes out at age 70. So if you are still working and have not filed for Social Security, or if you have not filed for Social Security, even if you are not working, it is not in your best interest to wait beyond age 70. At age 70, everyone should file for benefits, and it is not automatic. You must contact Social Security to start your benefit. They will not automatically just start sending you funds if you have not gone through the trouble of getting with them. So now let's take a look at the full retirement age, which again is the age at which you can claim full unreduced benefits. It used to be 65 for everyone, but now we're seeing a higher full retirement age being phased in because of the 1983 amendments. For everyone born between 1943 and 1954, it is 66. For everyone born 1960 and later, it is 67. And if you were born sometime between 1955 and 1959, you can see that your full retirement age is 66 in a matter of some months. So now we wanted to show you specifically what the reduction looks like if you decide to file early. So this middle column here means your full retirement age is 66. The right-hand column means that your full retirement age is 67. So starting with the far right-hand side, we can see that if we apply at age 62 and our full retirement age was 67, you will only receive 70% of what you would have gotten at your full retirement age. Conversely, if you were having a full retirement age of 66, you can see that your reduction would be 25% to where you would receive 75% of what would be expected at your full retirement age. Now, with Social Security and the reductions, it is prorated on a monthly basis. So what that means is if our full retirement age is 66 and we decided to apply at 62 and a half, our reduction, or we wouldn't receive just 75%. We might get 77 and a half if we're splitting the difference between 62 and 63. So even if you're able to wait an extra month or two, every little bit ultimately helps in terms of how much you end up collecting from the system over time. If we are to look at the other side of filing in terms of delaying, we see that we get an increase. So for every year that we wait, we get an 8% increase through what's called delayed credits. So if we start here with the middle column, if your full retirement age is 66 and you wait until you're age 70, you would receive 132% of what you would have gotten. And at age 67, it would be 124. It's less for 67 because you've only had 3 years beyond your full retirement age to accumulate those 8% increases on a yearly basis. Now, percentages may be a little difficult to fully grasp how significant of a difference it is from collecting at your full retirement age to 62, to 70. So on this next slide, we want to show you specifically what it looks like from a dollar figure perspective. So in this example, we are assuming that your full retirement age is 67 and that the amount that you would collect at your full retirement age would be $3,000. So let's fast forward now and let's assume that we are age 85. If we had started claiming for benefits at 62, we would be receiving $3,300 a month roughly. But if instead at age 85, we had waited to claim Social Security until age 70, we would be receiving over $5,800 a month. That is $2,500 more per month that you'd be receiving, which equates to over $30,000 per year. That is extremely significant, particularly if you expect to have a long life expectancy. And the average life expectancy for a woman here in the United States, I believe, is somewhere in the neighborhood of 87 to 88. And so there's a significant difference between claiming early and delaying benefits. And the one thing that is also very important to understand is that when you have a higher base that you begin at, when you get those annual COLAs, those cost of living adjustments, it keeps compounding on that bigger number. So the longer you end up living, the more significant the increase ultimately looks like. So now we're going to talk about 3 different types of benefits: spousal, divorce spousal, and survivor benefits. This area can be a little dense and there are a lot of nuances to it. So if anything is confusing or you need additional clarity, again, please use the Q&A feature and we'll get to it at the end, or schedule a time to speak. So with spousal benefits, you will get the greater of one of these 2 options. The first option is half of the primary worker's full retirement age amount. This is also referred to as the PIA, or the benefit earned on their own working record. So we have an example here below to explain this concept. So John's PIA is $2,000. That means the amount he could collect at his full retirement age. And John is the primary worker in this example. Jane's PIA is $800, meaning based on her own working record, she could collect $800 at her full retirement age. So if Jane applies at her full retirement age, she will be able to collect $1,000. She will collect $1,000 because 50% of John's PIA is bigger than her own benefit. So Social Security, when you report and you file for your benefits, you will explain to them that you are married and provide proof of that, and they will automatically calculate which one of these 2 options is higher and give you the higher one. So here are some rules. The primary worker must have filed for benefits. So in the previous example, if John had not filed for benefits yet, but Jane went to go collect her benefit, she would get $800 because that is what she is entitled to on her working record. You are only able to collect the spousal benefit when the primary worker is also filed for their benefit. You must be 62 to begin receiving your benefit, or that full retirement age to collect the full benefit. And then lastly, no delayed credits on the spousal benefit after full retirement age. So what does this mean? And I'm going to go back to the previous slide so we can look at this example. So if Jane applies at her full retirement age, her benefit will be $1,000. That is because that is half of John's PIA, or the amount he could collect at his full retirement age. So if John is to wait until age 70, for example, Jane wouldn't be able to receive anything more than $1,000 because $1,000 is half of what he could have collected at his full retirement age. And so while they're both living, that is where Jane would ultimately be capped. Now let's switch gears and talk about divorced spouse benefits. So they are the same as spousal benefits if the marriage lasted 10 years or more, the person receiving divorce benefits is currently unmarried. So if you are to claim on an ex's record, you must not be married to someone else. The ex-spouse must be at least 62. And if the divorce was more than 2 years ago, the ex-spouse does not need to have filed for benefits. So that is a big difference. So you don't have to, of course, coordinate benefits with your ex-spouse, which is, certainly the, benefit here. You would just, again, go to the Social Security office or do it online, and you would have to prove that you were married for 10 years and a day, and then also provide the divorce documents as well. So now let's go over some additional rules related to divorce spouse benefits. More than one ex-spouse can receive benefits on the same worker's record. And benefits paid to one ex-spouse do not affect those paid to the worker, their current spouse, or other ex-spouses. So let's give an extreme example. Let's say the primary worker was married to 3 separate people, each for 10 years and 1 day. All of them could begin to collect benefits based on the primary worker's record, and it has no impact on what each of them are able to collect, what the primary worker is able to collect, or if he is to get married for a 4th time, what his current spouse would be able to collect from the benefit as well. Divorce spouse benefits stop upon remarriage of you collecting benefits, not upon remarriage of the primary worker spouse. So what this means is if you remarry, you can't collect on your ex's Social Security. Whether or not they remarry does not impact your benefit. But if you remarry, then you can no longer collect on their record. Now we'll switch to survivor benefits. Survivor benefits can be somewhat complicated, but it's important to understand how they work because the decisions you make now will influence how the survivor benefits later. So there's 2 factors that influence the amount of the survivor benefit. The first factor is the age at which the deceased spouse claimed their own retirement benefit. If they originally applied for Social Security before full retirement age, the survivor benefit will be limited to the deceased spouse's actual benefit or 82.5% of the PIA, which is that full retirement age amount, whichever is higher. If the deceased applied at their full retirement age, the survivor benefit will be equal to 100% of the PIA. If he or she applied at age 70, the survivor benefit will include delayed credits. The second factor influencing the amount of the survivor benefit is the age at which the widow or widower claims their survivor benefit. If he or she claims it at 60 or 50 if they're disabled, the survivor benefit will equal 71.5% of the decedent's PIA. If he or she claims at full retirement age or later, the survivor benefit will equal 100% of the original amount. They may, of course, apply any time between ages 60 and 70, and the reduction will be prorated. So now let's go over some of the rules. So couples must have been married for at least 9 months at date of death, except in the case of an accident. The survivor must be at least 60 for reduced benefits, or 50 if they're disabled, or full retirement age for the full benefit. The survivor benefit is not available if the widow or widower remarries before age 60 or 50 for a disabled survivor, unless that marriage ends. And divorced spouse survivor benefit available if the marriage lasted at least 10 years. So here's some strategies that we want to go over. So what if you've already been widowed? Let's say that your spouse died either before or after starting Social Security benefits. Or maybe you were married over 10 years, divorced, and your ex-spouse has died. Is there anything you can do to coordinate your survivor benefits with your own retirement benefit to maximize income and lifetime benefits? The answer is yes. You can sequence your benefits to maximum advantage. You can start with one benefit and switch to the other. And that is such an important point that I want to say it again. You can start with one benefit and switch to another. The rule here is that you always take the higher benefit last. If the survivor benefit is higher, start with your retirement benefit at age 62 and switch to the survivor benefit at full retirement age. If your retirement benefit is higher, start your survivor benefit as early as age 60 and switch to your retirement benefit at 70. If you are ever in this situation, please call us. We will help you figure out what the best strategy is here. The main takeaway that we want from this particular slide is just understand that if you are a widow or widower, that you have options and that you can collect one benefit and switch to another. So now let's get into strategies on how we can maximize benefits. But here are some factors that we need to consider when we're determining when to apply. One is health status. If you've received a terminal diagnosis or are not in good health, that is certainly going to impact us potentially applying a little bit earlier than we would otherwise. If you are very healthy, as well as having good longevity in your family and a long life expectancy, that's certainly going to tip the scales to us trying to wait a little bit longer. The third is going to be a need for income, which dovetails nicely to whether or not you plan to work in retirement. Some clients like to pick up part-time work or consulting, or quite frankly, continue to work full-time, but do so in a profession that they find more fulfilling and possibly less stressful than the one that they're currently in. Determining your income sources is going to be very crucial. Beyond Social Security, are there any other pensions or investments that we need to consider? And lastly is survivor needs. And this becomes particularly acute when you have spouses that have large age differences. If you have one spouse that is considerably older or younger than the other, then determining when you file is going to have a big impact. Because when one spouse passes away, the survivor only gets one benefit. So while you're both living, you are each entitled to a benefit. And when one passes, one of the benefits goes away. So the surviving spouse, any way you slice it up, will ultimately be receiving less than when you are both alive. So here's ways that we can maximize Social Security. One of them is to improve your earnings record. As we talked about a little bit earlier, Social Security calculates your benefit based on the highest 35 years. So if you have not yet worked 35 years, there would be zeros that would be applied to your record. So anything that you can put on there to remove a zero is certainly going to help. And I would say most folks are generally at their peak earnings or close to the highest earnings towards the end of their career. So even one more year or two more years might significantly increase what you will end up collecting from the program. Secondly, applying for Social Security at the optimal time. This is where we are able to help you make this decision. It is too important to leave to guesswork. And one of the ways to maximize, of course, how much you collect is doing so at the optimal time. The third is being aware of the retirement earnings test. What this means is if you are receiving Social Security and you are below your full retirement age, Social Security will limit the amount of money you can make through work. Social Security was designed to be a retirement benefit. So the government says, hey, if you're collecting Social Security and you're still working, it doesn't really seem to us that you're retired. So what they're going to do is they will reduce the amount that you can collect from Social Security based on a particular threshold. Now, if you are over your full retirement age and receiving Social Security, you can earn as much as you want and there is no reduction. And then lastly, we want to reduce taxes so you can collect more Social Security and pay less in Medicare premiums by avoiding what's called the IRMA, which is the income related monthly adjustment amount. So the amount that you pay for premiums for Medicare Part B and Medicare Part D is what you reported to the IRS 2 years ago. It's called a 2-year look back. And if you are receiving Social Security and on Medicare, they will automatically remove your Medicare Part B and Part D premiums from your Social Security benefit. So if we can find ways to reduce taxes, not only will you be paying less income tax, but it might bump you down into a lower IRMA bracket, which means that you'll begin to collect more from Social Security as well. So there's tax planning can really impact you on many different fronts. We provide a free Social Security analysis to all of our clients. If we have not done this for you yet and you're getting close to when you need to file, we want to present this report to you so we can figure out the best time that you need to be applying based on your particular situation. Please call us, email us, set up a time to talk so we can go over this really valuable presentation. And this is an example of what some of the different scenarios look like. As I mentioned, for a married couple, there's over 80 different ways that you can file. And so what the software does is it calculates all of them and comes up with roughly 4 to 6 each time. And this is an example of one of the most valuable pages of that presentation where you can see specifically how this is going to impact you and what the lifetime nominal benefit might be given our assumptions. So is Social Security going to be enough to live on? For most people, probably not. Social Security is a way that you can supplement your income needs. But for most, ultimately, it is not going to be enough. And one of the main points that I had, brought up earlier, but it's so important, I want to reiterate, is that you do get those cost of living adjustments, which are supposed to be in line with inflation. But again, the inflation that seniors experience in America is generally very different than the overall population. The inflation, particularly for healthcare, goes up a lot more than the general CPI, which is how inflation is often measured. And so it's very important to understand that we can't necessarily rely fully on Social Security, also with the idea that we know reform is going to have to take place within the next 10 years. So when we ultimately file for Social Security, needs to be in the context of pensions, IRAs and 401ks, required minimum distributions, which is RMDs, your investment portfolio, and work. All of these play into when we want to make that decision. Regarding the pensions, did you select 100% joint and survivor? If you did not, then we will need to be extra mindful of what happens if you pass away first before your spouse. Because if they're not going to collect that same pension that you'd be getting otherwise, then we need to account for that loss of income. With IRAs and 401ks, exactly how much is in the investment portfolio? Well, every time you withdraw from an IRA or 401k, it's going to be fully taxed. So we need to take that into account because it's with after-tax money is how you pay your bills. That's how you go to the grocery store. That's how you eat. The required minimum distributions are something else that we'll need to be very mindful of too, as that continues to evolve. Most folks' required minimum distributions at this point are 73, and in a couple of years, it's going to change to 75. And then investment portfolio and work, those are hugely important. In terms of the investment portfolio, what are the assets that are in there? What is the income that it's generating? And also, is it after tax? Is it Roth? Is it a brokerage account? Also play into it. And then regards to work, are you working part-time? Are you doing consulting? Or are you even working full-time? That'll be very important that we want to consider as well. So you have questions and we can help. When should I apply for Social Security? What if I want to keep working? How much will my benefit be? How can I coordinate spousal benefits? What's the best long-term strategy for my situation? And what do I do next? Jordan, I'll turn it back over to you.
Okay, thank you, Sam. Appreciate that. Appreciate that very much. As Sam mentioned, we do provide this free Social Security analysis. And in addition to providing this free analysis to all our clients, if you know someone that might benefit from this report, please let us know, or please let them know. We're happy to provide them this information as well. There's over 89 different ways to collect benefits, and we're going to help you decipher the best possible scenario. In order to provide this analysis, we need your help. If you can go to ssa.gov, and get your Social Security statement, it's a benefit estimate statement. This is what we need to prepare the analysis. If you are married, for both you and your spouse. If you are divorced or widowed, we just need your benefit, and we can work with you from there based on other factors. Social Security is far too important for guesswork. We are here to help you protect your nest egg, maximize your retirement income, and look at the big picture. So at this point, I'd like to invite everyone to type in at the bottom a question. You see the icon, it says Q&A. We already have a couple of questions. And I'm going to begin taking question number 1. And the question is, please provide the data source for the long-term projections. That was in the very beginning slide that Sam talked about. That came directly from the trustees report. That is public information. That is the most current as of 2023. Our next question is, I turned 64 in March, and I want to retire at age 67. When should we sit down with you to do this report? That is an excellent question, and the sooner the better. This way we can do some planning and some projecting and give you an analysis with regard to a yearly update and going through all of the possible scenarios. And it may change your decision on when you apply and how you apply. Okay. Any other questions that are popping up? Sam, anything else you'd like to add?
No, I think you did a great job summing it up. I guess now that I say that, one more point is that there's no reason why we need to leave this to guesswork. This will be one of, if not the most important decision that is made in retirement. So let us help you run the numbers through our software tool so we can help you make that decision with confidence.
Okay. Well, thank you, Sam. Well, at this point, we want to say thank you very much for your time. We will be sending you the replay. That'll be sent to you by end of next week. Please call the office. Any questions, we're here to help. Thank you. Have a wonderful day. Bye-bye.
Thank you.